Let's jump into it. We're being recorded here, so anybody that is not able to attend, we will be sharing this across all our social channels for people to tune in at their leisure. But let's jump into it, Navin. So thanks for joining us. Why don't you introduce yourself for the audience here?
You got it, Matt. Thanks for having me. I think this is my second time on with you guys. My name's Navin Bhutani. Much to my mom's chagrin, I switched from being a tax attorney to being a commercial real estate broker about a decade ago. And that's all I've been doing since then. I spent a few years in-house running the real estate at a private equity funded restaurant chain called Dig. It used to be called Dig in New York City. And outside of that, I've acted as either a national or regional broker for a number of different brands. I do that work currently for Dig as their national master broker. And then for various other brands like Allbirds, Berries, Dig, Dry Bar, Brooklyn Boulders, Clean Juice, Juno Medical, kind of all verticals of retail and all territories of the United States. And so the benefit of that is always good. I have a good network of brokers in all the major metros. And so what that allows me to do is have a reasonably good pulse on what's going on in any given market, which is just helpful because it helps with deal making in other markets. As you start to strategize and you're talking to a client about, hey, should we be focused on Texas right now? No, you shouldn't. Rents are crazy and the landlords want to give you $5 a foot in TI. And oh, by the way, they're the only market I've seen where they're trying to get 7% annual escalations because of inflation. Like that's the kind of stuff that I won't learn if I'm just focused in one market. So I've found that to be really valuable. And that's the core of my business on a day-to-day basis.
Cool. I am Matt Giffune. I'm one of the co-founders of Occupier. We're a lease management software company. We handle transaction management, lease administration, and lease accounting compliance in one platform. We work with a very similar customer base as Navin. So for retailers that are looking to centralize their real estate processes, that's what we do. So enough with the sales pitch. And let's jump into it here.
Let's do it.
Well, you just in your introduction, Navin, well, let's set a backdrop here. When we were trying to figure out what the content we wanted for this webinar, we iterated through a few ideas, and I think we landed on, at least you landed on, the topic of knowing when to sign a retail lease and when to wait. And I think that's really an awesome idea given kind of the backdrop of everything that's happening both macroeconomically and then also like micro in certain markets. So we'll dive into some of the reasons why, some of the strategies that you think we should employ. But let's kick it off with this statistic right here. So vacancies dropped sub 7%, right? For the lowest quarter in 15 years. And, there seemed to be this massive pendulum shift post-pandemic to just this really aggressive expansion by, not only emerging brands, but also traditional brands. So what do you think made up for that, that strong, rebound? And, where is kind of the state of the market right now?
Yeah, look, I think when you and I first connected on the webinar, it was like July when my second kid was being born. And so
yes, congrats.
It was still, thank you. It was still early in, hey, what is going to happen right now with real estate? There was a lot of talk about everyone's going to be back in offices and, oh, it's okay. This is just a temporary slowdown, or rates are rising. So maybe home prices are going to stall out. There's a lot of that conversation. There wasn't like full-fledged, like this might be a long problematic issue. And so now fast forward several months, and I think there's just a lot of signs that things have gotten very hot. The stat you have on the screen with the 6.1% vacancies, like that is a product of retailers sat on money in 2020 because of COVID. And so they had to deploy that capital in 2021 and 2022. So the market just naturally had built up. And so that money got deployed very quickly. You also had that being like particularly true down in the Sunbelt states because of their business policies that was more inviting. And so a lot of these retailers that previously were like, I'm focused on the coast, really New York and LA and like broader mid-Atlantic. All of a sudden they're focused all in one series of markets, which is why landlords in Texas might be doing what they've been doing, which is like, we're just going to basically deliver an empty box and here's a few bucks. And that, like, now layer on the next component here. Core business districts are a question mark. So you now have an inflow of these same folks only focusing on urban residential markets, I think Upper East Side, Upper West Side, Williamsburg, and also straight suburban markets. So like I'm in the DC, Maryland, Virginia area. Like these suburban markets are on fire. Rents have gone from $40 a foot to $65 a foot in some cases in a lot of these properties. And so you put all those things together, and it's just been a very friendly, a very favorable market for landlords, and tenants have been in a tougher spot. But they kept moving things forward, I think, because consumer spending with COVID stimulus checks was up. There was no problem. And so I think it's just, you don't want to miss out on the action. You're trying to grow your brand, but you are running into this headwind where landlords are just in control.
Yep. And maybe those landlords that are in those CBD areas might be struggling a little bit because they're not desirable places to expand right now. And we could pull a thread on the office market and how that's impacting things too, but let's save that for another conversation. So obviously there's macroeconomic changes, right? Cost of capital, construction costs, inflation, interest rates going up. Like it's like this perfect storm of, economic headwinds that are basically saying like, sit on the sidelines, don't do anything, let this thing normalize. What's your take on the external factors that are pushing into the decision making?
Yeah, look, I think between July and now, and why I think we shifted the focus of this conversation, it's primarily because of external factors now. I think it is lumber costs have stabilized, right? Let's say lumber costs are normalized now, things are not crazy. But the cost of construction is considerably higher than it was before. I talked about the Texas example. I'm getting LOIs back on national credit tenants where they're like, no, we're just going to need to get 5 to 7% annual increases in rent. Or, hey, where we used to give you 3 or 4% controllable CAM caps, we're going to make that 10%, or we're just not going to give you a cap. I mean, and they're giving me some examples of where costs have gone up. So I do understand for the landlord's cost, why the perspective, why they can't agree to certain CAM caps, because the service costs have gone up. On the rent going up at those percentages, I basically would have to be like, show me your loan documents that you have a variable rate on this property, because otherwise, like we're not agreeing to a 10-year lease where our rent is going to be 3x at the end of this thing. Yeah. I'm exaggerating, but you get the point there.
Right. Right.
The other part of this is residential and suburban rents, as we talked about, are way up. Forecasts on revenue are up higher because of inflation, but no one's like, oh yeah, we can just charge $20 for a bowl of food instead of 12. Like that's not a thing. So how do you keep your payback periods going and keep growing if you're running into this sort of issue? And I think if we're talking about external factors, I don't know that everybody's talking about it, but I'm specifically paying attention to it, is the inflation reports recently are good, right? It is coming down. That is positive. Nobody's really talking about the fact that spending on goods is down for 3 consecutive quarters. Spending on services is up, but that includes like hospitality, travel, and other services, like obviously. But when it comes to goods on spending on goods is down 3 consecutive quarters. That's going to impact a lot of these retailers. And so while I don't have like a mass of clients who are just like, hey, these are reasons we can't grow, you can see that folks are taking longer to deliberate on things that 6 months ago to a year ago would have been like, hey, we got to go, because if we don't, so-and-so tenant is going to take that space.
Right. Yeah, the brakes have put on a little bit, and I guess hopefully for the retailers, what that means is those landlords in Texas have to pull back a little bit on the rent escalations or the TI amounts, et cetera. Like hopefully it ebbs back to the occupier side of it. But it's interesting, kind of the juxtaposition of what you said is that those core suburban markets like Austin, Texas, for example, you can every brand is there now, right? And that the dynamic in that market right now is like, well, now if the tenants come back into control because the economy stabilizes to some degree, the power goes back to the tenant, and hopefully, that's when people jump in, which is the theme of this whole webinar, which is like knowing when to do it and when to wait.
Right. That's right. And you see that like borne out in a few specific markets. Like you talked about Austin, Nashville's another situation where you're like a lot of retailers are talking about Nashville. I've seen suburban rents in Nashville where I thought the rent would be $50 a foot come out to us at 70 or $75 a foot. So you're like, you just naturally need to slow things down to bring that back to some sense of normalcy, because again, it's not certain. You're seeing return to office conversations happening left and right. I think Snapchat was the one people were talking about yesterday because they said 4 days a week. It's not clear how this is going to shake out. So if you over leverage into residential and you pay big rents and then the revenues start to dip because it goes back to CBDs, you're going to run into a problem again. So you just have to be thoughtful about your business and really figure out the right time to deploy this capital.
Yeah, which is, a good segue to this next slide, which is who should be signing leases right now. And reading this slide, it's very clear that, to what you said earlier, it's the companies that have this investor capital that needs to be deployed and have a strong value prop and have good, strong demand for whatever their goods are that they're selling. So, talk a little bit about that.
Yeah, I mean, look, I think franchises grow in recessions, right? Folks lose their jobs, they have money set aside, they don't want to go work for somebody else, and it happens to coincide when typically rents are coming down, things are becoming a little more affordable, and so they can take this shot. But I wouldn't be, even if I was a franchisee, I wouldn't franchise like a $75 haircut, right? That's not a thing that I think you should be leaning into right now. If we're talking about great clips or haircuttery, very strong value prop. If people are always going to take a cheap haircut. You have to do it every month, they're going to do it. If you're insomnia cookies, you're probably fine, right? People are going to be eating cookies and spending $2 is not going to break anyone's back. But outside of the strong value props, the other side of that, of people who should be doing deals recession proof, are, let's take medical providers. Like the demand for medical providers, primary care offices, is not going to fall off a cliff. Amazon bought One Medical, or whoever bought One Medical. Like those guys, I might have the buyer wrong, but like those guys can keep growing because that business is there. And there's a great value prop too. It's a better experience than typical primary care offices. So those types of businesses, by all means, continue to grow. Makes good sense to me. And then you've got the other side, which is like, hey, people have given us money to deploy. We actually need to deploy it. Now we can bring back our growth from 20 to 30 units a year down to 8 to 12 or 15 to be a little bit more thoughtful about where we're expanding, being a little bit more opportunistic. And we'll talk about that a little bit later here and finding the right deals. But that's the other part of retail. That's the other group of retailers that I can understand why they need to grow. But again, you're doing so thoughtfully. For everyone else, to me, and I know it's weird for a broker to be saying, I only get paid if people sign deals. It's a little weird for me to be saying it, but I think having some period of short-term pain is much better for the industry and for us than not having a bit of a slowdown right now. And how that I think ultimately plays out is you've got I lost my train of thought there for a second. You've got leases that typically take 2 to 3 months, now taking 6 months. So like that's a lot of that is construction costs. And we're not talking about it here, but like if for 3 to 6 months, a lot of retailers sit back, assess, and then start to grow, people that have clung to these higher prices, because we know that's what is happening, right? To some degree, vendors are out there and like, well, we've been charging 3 times the price for HVAC, or our suppliers charging us 3 times the price. Like that person's not bringing the price down just because right now things are okay. But if you pull back demand quite a bit, I think you ultimately bring those prices down. So it's actually just better for everyone, for retailers to pay attention and just kind of assess what's going on for a bit before they start really deploying cash again.
Yep. So what about the companies that like need to sign a lease right now, whether it's a renewal or you have been sitting on capital for the last year and you need to deploy it? How do you do that without, making a bad move? Like what should tenants be focused on?
Well, I think if it's my money, which is how I try to think about all my tenants, if it's my money, I'm focusing on controlling CapEx costs because they are just unexpectedly high. I mean, I've had clients that sign a lease that had bid out the work, and then 2 months later, when they're starting construction, multiple subs are raising their hand and being like, we can't honor that price anymore. You just can't have that. And so controlling that CapEx cost, meaning minimizing the amount of investment you have to put into a space, is going to be really important to me. And the second thing is delivering on customer experience is what I'm going to focus on. And that is because we talked about spending on goods dropping. So I don't know how long that's going to continue. I'm not going to assume that it's going to stop the day that I open my doors. And so how do I make sure that there is some value to me opening this location? It is building lasting brand loyalty and providing a tremendous customer experience, because that person will come back, certainly during this time that it's slower, maybe in a lower cadence, but certainly when things are back into growth, like, you're going to be top of mind for that thing. So you've actually put your money to good use in actually building a base of customers who will stand by you when things are better.
Well, what are some of the things that companies are doing? Like, let's just say you have an existing footprint of stores and you're not going to be investing in expansion programs, but you do have capital. You mentioned building, customer loyalty. Are there within the existing footprint strategies that are being deployed to, whether it's renovating stores or putting new, technology or concepts into these locations that might, build that brand loyalty a little stronger?
Let's separate the analysis for a second. Like, the first step, I think, is just understanding how much runway do you have if things go really badly for a year. So a lot of brands are slowing things down just because they want to conserve cash. Cost of capital has gone up fairly materially with the Fed doing what it's doing. And so if you feel like your business is not one of those high value prop businesses, you want to spend money very thoughtfully, sit on everything else that you can, in all likelihood. And the money that you're spending carefully, I think, then goes to what you're talking about. So if you've got a mobile app, but you haven't optimized customer pickup in your location, or if you haven't set aside an area with signage that's clear or dedicated square footage to convenience, those are things that you should do, because over the last couple of years, I think we've shown people really want convenience. I mean, I think Sweetgreen just opened their first drive-through offering somewhere outside Chicago, if I'm not mistaken. It's about convenience. There's other brands, Starbucks, that are opening pickup location only, right? Like, you order online, grab your stuff and go. So if you're seeing these big brands doing it, there's probably a reason, and they've probably spent a lot of money researching it before they've done it. You don't need to reinvent the wheel. If you're going to spend some cash, focus on customer experience by doing something like that. I mean, there's other brands I've heard of that are shifting some of their strategy to have a little bit more retail. If they were just a services business, offering a little bit more retail in the space to try to split up the revenue streams. But that, I think, is going to be a very subjective thing. It won't be very helpful for me to just kind of talk kind of randomly on that. But while we talk about these retailers and everyone else waiting to reassess in 3 to 6 months, that doesn't mean sit on your money, sit on your hands, don't do anything. Like, that would be a big miss. I think this is the time to figure out, okay, if we are slowing our growth right now, what are we doing coming out of this? Do we need to adjust our square footage up to offer that better customer experience? Do we need to renegotiate some of our current deals where the space doesn't operate in a way that we think is productive, and so we can approach the landlord now when things are slowing down and get a better rent for the remaining term of our lease? Do we look at our portfolio and just make sure we fully understand? I mean, you're an occupier, you get it. I should be paying attention to my portfolio and understand when my renewals are coming up, and strategically what I'm doing with my spaces. And so, like, this is the time to do all that. Having been in-house at Dig when we were, after our Series C, I think it was, like, we were moving fast. So having a moment to slow down and focus on doing things the right way, setting some foundation, this is the chance to do that. If you're not one of those people that are growing right now.
I feel like I could have solved that problem for Starbucks with just like one conversation without them investing millions of dollars into research. Because how annoying is it now when you go into a Starbucks physically to order a coffee, but there's like 45 online orders in a queue, and they just put you in the same queue, and you stand there at the counter waiting for them to make your drink, and you're the only person in there.
Yeah,
they're just making.
It's hilarious that you say that, because it's not only that you're in the same part of the queue is that you have to say your order, the whole thing. Like if I order a pretty basic drink. I'm ordering an oat milk latte, right? So like that, I don't have any special stuff. I've heard my wife and other people order like, I need light ice, I need this added, I need this. And I'm just like, you hear somebody in line, you're like, if on the app you order that one time, you just heart it, like that's a favorite. You just click that and it'll order it at the closest Starbucks to you. It literally couldn't be easier.
Yeah, I know. Well, hopefully, yeah. There's always, the good feeling of walking into a coffee shop and getting a coffee though. But all right, so let's talk a little bit more about deal strategy, right? Like if you are doing deals right now, if you're going out with Dig and they want to open a new store in a certain market, city, neighborhood, whatever, like what are you looking for?
So look, I think in a normal environment, people want second generation spaces, right? There's always the decision between, do I want new construction because it's shiny and clean and there's not likely to be a bunch of problems in it? Or do I want second generation space? So once people have made the decision that they want to focus on second gen space, it's really just optimizing for delivery conditions. You're trying to reduce your CapEx costs. I think the wrinkle now is a little bit different, which is you want to focus on second generation spaces for sure, because it's going to bring your costs down. But secondly, if there is work that needs to be done that you might have typically done where it's like, hey, the landlord's telling me there's an extra 200 amps and it's 20 feet away, I can just pull it, put it in a panel, like those sorts of things that you can put onto the landlord, do that. Because for one, the landlord has more leverage on the local contractors than you do, unless you're trading in your own market and you've done 20 deals around there. The landlord's always going to have more sway with the construction guys and the subs. And so let them take on the risk of the variance in construction costs right now and leverage their relationships to do it at a lower cost. And then that way you have to do less work, even in these second generation spaces. So I guess the short way to say that is any work you can put on the landlord, do it, because the construction costs are all over the place. And I think the second part of this is focusing on finding the right landlords or the right properties where you're an amenity. I mean, you look at Bluestone Lane, they're popping up all over the place. They generally locate in really great properties, really great spaces, but they also lean into the fact that they are a great amenity for these multifamily towers or even an office tower. So if you know that, you can end up getting really good rent structures or much better rent structures than they're willing to offer to XYZ tenant who just happens to be paying the most rent. Now, there's a lot of landlords that say, I'm not a last dollar landlord. Like I'm not just chasing the highest rent. There's far fewer that actually live by that mantra, which is like, hey, I should actually just bring in the best tenant, even if it means leaving a little bit of money on the table. But that's kind of the second thing. Find the right partner, because if you do, they're going to treat you fairly and actually reward you for doing a deal with them versus another random tenant doing a deal with them.
Yeah. Have you seen lease structures changed at all? Are we still looking at like traditional rent schedules and percentage rent shares? I know that at least in the office side, there's starting to be this shift towards management agreements or operator agreements where a third party might come in and operate a portion of an office tower for co-working or flex office, for example, that might not be priced on a per square foot basis, like based on the market. Are you seeing that at all in retail?
In retail, more recently, other than the stuff we talked about earlier, where I'm seeing just much higher, either no cam caps or much higher caps or much higher rent escalations, setting aside the actual high rent. The other thing that I am seeing thrown into a lot of residential deals and now occasionally on street deals is percentage rent. Like it's just in markets where I wouldn't expect to pay percentage rent, we're seeing it. The way that I offset that is I will try multiple times to strike it. And then I will figure out from my local folks, like, hey, this is like actually a thing they're not going to give on. And the way I'll work around that is set an unnaturally high breakpoint. It's got to be high enough where I'm literally just rewarding you because I'm outperforming, not just because I'm hitting my numbers. And you have an added value to me by like giving me this great space or great co-tenancy. Outside that on deal structures, I haven't seen, unless I'm forgetting something, I haven't seen anything that's like really changed on the retail side. Lower TI offerings in certain states where there's a lot of competition. And, we talked about the 6.1% vacancies. In some markets, that 6.1 is probably high. It's probably lower than 6%. Midtown Atlanta is a perfect example of a place where there's just nothing. There's just nothing for a large space.
Yeah. Well, we touched on this a little bit earlier when I asked the question of like, what could brands do like within, outside the, the brick and mortar, leasing strategy, convenience, customer experience, brand awareness. Everybody should have a mobile app right now, right? Like everybody should have a different area to pick up the food than stand in line and like order your bowl of food. Like what should brands be delivering on? Because like I live in Boston. I'm right near Copley Square. You have pretty much every name brand, Sweet Green, Dig, Kava. Everybody serves lunch along Boylston Street in Boston, and it's just kind of it's fascinating to me how some places have a line out the door every day, and other places are, just empty. Like, what makes the good ones stand out versus the ones that are struggling to attract a crowd?
So I think the one part, the last thing that you said, I think we'll just lump that into customer experience, right? The quality of when you're spending, now that food prices are even higher than they were. I mean, at Chipotle, you're going to spend 12 or 13 bucks pretty consistently now. And so like, if you're spending that much money, you just want consistently good food. So a brand like Dig, a brand like Chopped, Sweet Green, Chipotle, like they'll continue to be fine. And so long as there are people around, they'll be able to sell food because it's consistently good. You're not going to go spend 13 bucks one day and have terrible food. Or if you do, it's a very rare occurrence. So that, like, quality is going to win. And I think more brands, setting aside COVID supply chain stuff where I think some quality did go down, I think the smart brands are certainly focused on delivering quality. And so all that goes into customer experience. But, I've talked to you, let's stay on this category, customer experience. I go to Bar Taco all the time. I live, right next to Reston Town Center. You order with the QR code, you can just get up and leave. Your bill gets closed out. I mean, as far as I'm concerned, it's optimal for me not to have to talk to someone. And I like talking to people. I just don't want to have to place my order. If I sit down, I'm in a hurry, quick, order my 3 tacos. My food's out in like 5 minutes. It's like a sit down experience, but delivered to you like a fast casual in a nice 4,000 square foot space, not like a 1,500 square foot Chipotle, for example.
Yeah,
so I think those. Yeah. What's that?
Yeah, like an assembly line. Yeah.
Yeah, exactly. It just feels, and I think there's going to be a movement towards that, right? The more you're charging, the less it needs to feel like fast food. It can't feel like that. If I'm spending $15, I don't want you yelling at me. I just don't want to. Convenience for sure. Mobile apps are critical to success. I talked about like saving your order history. That alone is very helpful, right? Like for my dog, I order from Chewy's. Sure, I'm not going to Chewy's, right? But my food shows up, or I order, something for my dog. It's here 24 to 48 hours later, and like I don't have to search for anything. It's just like, oh yeah, I need this medicine, I need this food, I need this treat, and it's here. So mobile apps, whether it's for delivery or for pickup, is definitely an important thing. I still think certain brands, I wish I could remember what I'm thinking of right this minute, but when I try to customize my food option, like I'm not allowed to, which I fully sympathize with the brand, like letting everyone customize everything. It would be really problematic or would ruin quality because things would be missed. At the same time, I'm like, every dollar more I'm paying above a normal, I expect you to give me what I want. So like Crumble Cookies sells fairly expensive cookies. They're crushing it, right? They've opened hundreds and hundreds of locations. They change their menu like every 6 days or every 7 days, like the cookie calendar. So like they are trying to deliver to the customer. And so like that goes into customer experience. It also goes into convenience. They can do both of those things with their mobile app and being able to give someone like anything, right? Any variety if they just pay attention to what's coming out. Brand awareness, this is not directed at direct to consumer brands. But I think they're figuring out what they're doing. And I think we're talking about that on a later slide, but like that, if you're going to open a location for Purple Mattress, right? And I don't know their real estate strategy, but like if you went out and opened 10 of those in the DC, Maryland, Virginia area, and there's enough population here to maybe argue that, and education and money to maybe argue that's the right number of units, I think you're going to start to see, now that all these brands are wholesaling to other retail brands, I think you're going to see them also focus on like, hey, maybe I should just go to those 2 or 3 kind of retail destinations in this area, broader area. And the folks that want to experience the brand, like let's give them a really great experience. And then everybody else, once they've experienced, they're going to go home, they're going to deliberate on buying a mattress, and then they'll go online and purchase. So I like brand awareness to me. If you look at Chipotle's real estate and Starbucks real estate, like that's a perfect example of like brands that have just leaned into, and obviously it's grown over time, but like they take corners only, they take freestandings only. I mean, Buffalo Wild Wings does that. They came up much later, but like that's the kind of things where you focus on brand awareness. You start to realize brands just because they're taking really great real estate and letting people see them. And then naturally, once the customer comes inside, you actually have to deliver on that by giving them that customer experience and making it very convenient for them to get in and out, be that pick up parking spots, things like that, mobile apps.
Yep. Okay. Yeah, you're right. We're going to talk about that. It's the next slide. So, so you have the strongholds of Apple, Nike, Target, Lululemon, Home Depot, et cetera. Like how do the up and comers compete? How do they emulate what the incredible brands have been doing?
Right. Yeah. And I think these are, Nike's doing their live stores, which are like focused on what's going on around that area with what people are actually ordering. Target, I think you and I talked about, like I go to Target 3 times a week. My wife orders for curbside pickup. It's like brought to your car in 180 seconds. And you can specify which door you want them to put it in. Like, I don't know how much easier you can make it for a customer. So like set these things as the gold standard. Home Depot, you walk in, you pull out the app and you can like have it tell you which aisle and which bin something is in, which like I now don't have to ask anyone for what I'm looking for at Home Depot or Lowe's or any of those big chains now for that matter. Lululemon, I can order stuff online. I can do buy online, pick up in store, which has had a massive shift upwards. Right? I think like half of customers are doing that to save on customer costs. I think Fast Company or somebody had a stat on that recently, like 48% of people are doing it. For me, it was great. I bought some pants at Lululemon. I can go in there, I can exchange it, I can try on other stuff. They have my history. If I'm like, oh, do you have this? And they're like, oh, you want this that you bought last time? Yes, I have it right there. Like those kinds of things make you feel like you are a regular, even if you're not a regular. I've gone in that store like twice ever, but they know what I want. So when you look at how do the small players emulate that, I don't know that they have to do exactly the same things, right? Like I don't think pop-up grocer needs to tell every person where each thing is in the store like a Home Depot. Their store's not as big. But I do think taking the best in class from like a Lululemon saying, oh, you've ordered these other things at our other pop-up grocer location. At this one, you should check out these 3 things. Like that would be a nice touch. Those are ways that they can lean in. For Bar Taco, they do their seasonal tacos. They do the order at the table. I think those are things that a larger restaurant might do, but they did it at a much smaller scale. Dig during the recession during COVID had started doing, farm boxes, essentially shipping you produce because the restaurants weren't full. And that another way to just connect with your folks and give them another thing to order. If that sticks, maybe Dig will launch that again, right? And let you buy these farm boxes anytime. But there's a lot of ways to optimize your customer experience. And it really is mostly just putting yourself in the shoes of your customer. What does that person actually want when they come in here? And then look at the guys, the businesses that are doing it best and pick and choose what works. I saw something super cool a couple days ago. Which the franchise has created, they've had online kiosk ordering forever. And I think their business, it's called Yellow Labs. I think it's their own internal production, but you go to the ordering like screens and you get a live agent helping you order, who's speaking to you, who's not based at that location. So while you're interacting with the kiosk, you still get like some level of like, hey, I don't know what I want, or like, I want this, can I change this? And so like they can help you with your order. I'm not certain if they can place the order for you or if they have to like bring up the screen for you to do it. But this is like a franchise brand. Sure, they have a ton of locations, but like they're trying things to make the experience better. And I don't even know that McDonald's tried like order at kiosk with somebody talking to you. If they did, I'm speaking out of turn here, but like a brand like Which doing that just shows you the small guys are not prevented from doing stuff like this, because a lot of these technologies have been made much more accessible by all brands and not just the folks that have $500,000 to spend.
Yeah, it's like when you go into like a Wawa and you have to build your own sandwich at that kiosk, and you're like, wait a minute, like, are those the banana peppers or are those like the whatever? And
Right.
you order the wrong thing, and the person at the counter just makes what comes through on the ticket, and you're like, ah,
Right.
that's not what I wanted, you
Right.
know?
Right.
Yeah.
And I'm
All right.
someone who'd speak up and say like, that's a mistake. I got that wrong. There's a lot of people who would just take it, and you're like, I'm paying $12. Like, I'm just going to take it. Like
And they
that
don't
kind of
come
stuff.
back because it's annoying. The next time
Correct.
they're like, I don't want to deal with that. Yeah.
Correct. Correct. Yep. That's exactly right.
All right, cool. Let's wrap this up. This is obviously a heady question, and you don't have
Yeah.
a crystal ball in front of you. Maybe you have one on your desk that I can't see. But ultimately, what does the future of retail real estate look like?
This one, I think I just, you put yourself in the shoes of the consumer. In my case, I'm just going to use me as a consumer. I don't think I'm a perfect match for everybody, but I think the folks that, I lived in New York City for 10 years, lived in Pittsburgh for 8 years. I grew up in DC. So like folks that are around these markets or live in the cities will certainly have some similar thoughts to what I'm talking about. And I think that comes down to landlords, perfect timing, landlords and retailers focusing on experience, guest experience. So Reston Town Center has, the Christmas tree lighting was on Friday. They had a Thanksgiving Day parade. They have events all summer long, like Sunday, or Saturday morning at 10 a.m. There is live music and shows for the kids. Sunday evening or afternoon, there's live music for adults. Wednesday, Tuesday, like there's shows and music. So they're activating the green space. It actually happens to be right in front of Bar Taco and Barcelona. And so like the landlord is focused on customer experience, right? In parking lots, you're seeing more and more of the good landlords putting in the lighting system where it's green, where there's an open spot, red where it's not. So they're again trying to make it convenient for you to come back to this gathering place, this place to hang out more frequently. And so if they're leaning into that and retailers are leaning into that, I think the future of retail real estate just looks a lot less like disjointed small strip center with no access. There's always going to be small strip centers. I don't want to sit here and say there's not going to be, but I think there's going to be a lot of focus on creating a place that people want to hang out in, and then bringing in the types of tenants that will make that experience feel like special. And so whether that's Warby Parker changing the way that you experience when you walk in and somebody really guiding you through the process, or the Apple store, which I love using an example, you go in there, like, you know exactly what you need to do. And if you don't, they'll see that you don't know what you need to do and they'll come help you. It's just going to start to be a lot more retailers, I hope, focused on when you come into my store that is branded like my brand, you're going to get a very different experience than when I'm wholesaling to some big box or some other retailer where you're going in there and I'm just something that you're thinking about buying, not like experiencing. Yep. And I think that'll be the way you'll see brands really succeed.
Cool. Navin, this has been great. I am going to open it up for 5 minutes of Q&A. Does anybody who's participating here want to throw a question in the Q&A? Now's the time. Give it a couple of minutes to fill up.
Sounds good. And thanks again for having me. And thank you, Morgan, for helping so much. Getting this done.
Morgan Beard, our head of marketing, is the maestro behind our webinar series, and she's done a great job here. All right, cool. Well, I don't see any questions coming in. Navin, if people want to find you, how do they do that?
You can email me at navin@locate.ai. If you look on this slide, my first name @locate, and then just add a period, AI for artificial intelligence. That's probably the easiest way to reach me. Yeah, that's probably the best way to reach me. And I will respond because I try to keep inbox zero. So
same here. We actually did have a question slip in here from a guest. Have you found lease terms shortening?
It's strange. I've definitely, I guess that was one thing I didn't touch on. I have seen landlords, I think because they think they're giving us a deal, that they're like, I don't want to be stuck with this for 10 or 15 years with 2 or 3 5-year options. So I've had some landlords on certain tenants where I'm like, I'm surprised you don't want us to have options to stay. And I think that's a product of two things. Like I said, they don't want to undermark themselves if inflation is haywire. which is too early to say that it won't be haywire, but again, it does look like it's stabilizing. I think the second part of that is, think about in the past, you had certain brands stick around forever and they never invested in their spaces. They never made it nicer. They just existed and they had cheap rents and they were able to stay in these great shopping centers or lifestyle centers at well below cost. And because you've seen brands succeed now that are focused on customer experience and creating a great space, I think landlords just understand that they don't want to have the old player in that, the old guard in their space. And so if you're not on top of your game, they're just not going to renew you, because there's enough people out here now that are trying to deliver customer experience and convenience and just a great retail shopping experience. Yeah.
Cool. This isn't a question, but Ashley chimed in saying that she's attended a lot of these sessions. This is by far the best one she's seen in a while. Super insightful, and she's a landlord, so she's tuning into this to get better insights as to the retailer's perspective. So Ashley, thanks for that comment. Really appreciate it.
Yeah, thank you. Appreciate that.
Awesome. Well, Navin, thanks for your time. Everybody who's joined, thank you as well. Share this among your friends once we post the recording, and have a great rest of your year.
Thanks all. Appreciate it. Thanks for that.
Bye now.